9. Determine the financial implications. This is where we start to get into the cash flow model and understanding what the cash flows may look like for our particular business. The status for this section is controlled by these drop downs here. There's one there and there's another one further down here. So just update those and then our status bar will update. Looking at the assumptions, we want our forecast period to begin on a certain date. There's a pre-programmed date in there, but feel free to type over that. Currency we want to operate in. All these green cells here can be entered into, and the white cells generally are not for entry, but we'll have a look in more detail at that in a moment. So we have two different scenarios that we're going to be analysing automatically in your output documents. And they are a best case scenario and a worst case scenario. Oh, sorry, I should just explain the discount rate first. So the discount rate is a rate that's used for discounting future cash flows back to today's value. And we need to set a discount rate. Now for early stage ventures, a typical discount rate could be between 35 and 50%. And for later stage businesses, they may already have corporate discount rates they can use. But again, anywhere from probably 15 to 30%. If you're unsure about the number to use there, just leave it as the default, and you can see the implications of that come through in your plan. A best case scenario is if everything went exceptionally well, how the business would perform going forward. And so the statement here is operating income is higher than expected by, so we're saying income is up 50% and operating costs are higher than expected by 30%. Now the reason costs are also higher is that with most products or services, earning more income is also associated with earning more cost. So we do need to have a positive figure there. So yeah, just put that in. 50% and 30% would be a typical best case scenario that we would tend to go with. And a worst case scenario, sales are lower than expected by 30% and costs are lower than expected by 10%. So again, using that same factor. Now we have a valuation multiplier. If you're unsure, again, just leave it as the default of 3. But if you're aware of valuations in your particular industry, you can set that valuation multiplier to 20 number up to 100. So then moving down into the cash flow forecast, here we have cash on hand, starting period, so we could say that's $200 from the outset, and you'll just see the numbers update automatically there. Cash sales, how much we've actually sold in terms of cash and credits from collection accounts. And this is proceeds from loan or capital raised. So enter any capital raised or any planned capital raised even into these sections here, because that will flow through. These purchase details here are controlled by another section of the document where you state what you're actually what you're doing. You can type over those if you need to, or change them. Some of these categories may or may not suit your business, so it's really up to you to make sure that all the cash expenses listed are relevant. You won't be able to add or delete any rows or columns, but there should be plenty of rows there. If we just go across a little bit, over here we'll see all those first year is done in months, and then the following year is done in years up to year 5. So it's a 5-year cash flow forecast. And those numbers are used for a series of calculations that you'll see once the final documents come through.